This week on the Business Owner's Corner, I'd like to talk about 2 year-end tax planning strategies that might be a consideration for you if you're charitably inclined. We're at the period of the year where we're launching into the fourth quarter and people are starting to think about closing the books on their tax year. And for anyone who's trying to reduce their tax bill, gifts to charity might be top of mind. Now, as you might recall, we have this thing called the standard deduction versus itemized deductions on our tax return. The deal is everybody is entitled to a certain amount of standard deduction that depends on whether you're single or married or head of household or married filing separately, depends on your filing status. Everybody is granted a certain amount of deduction. Your itemized deductions, including charitable gifts, interest that you might pay on a mortgage, state and local taxes, you add all those up, and those are itemized deductions. If your total amount of itemized deductions is less than the standard deduction that everyone in your tax filing status is entitled to, you don't take any of the itemized deductions, you just take the standard deduction. If the total amount of itemized deductions exceeds the standard deduction everyone is otherwise entitled to, then you don't take the standard deduction. You list out all your itemized deductions on Schedule A, and you itemize your deductions for the year. Now, here's where this comes into play when we think about giving to charity. If you're someone who wants to pay less in taxes and you want to give maybe a couple $100 to charity, or maybe old clothes or household goods, or maybe even a used car or something like that, these are all items that you can give to charity and potentially deduct. That being said, it's not going to help you if the total itemized deductions that you have for the year falls below the standard deduction. And so one tax planning strategy a lot of people like to consider who are in this situation is lumping all of their charitable contributions for several years into what's called a donor advised fund. So let's say, for example, your standard deduction is, I'm going to use a round number, $12,000 as a single person. You have $15,000 of itemized deductions before your charitable gift. Well, if you're in that situation, every dollar of charitable gift is going to benefit you because you're already above that threshold and your itemized deductions just go up and up and up. Now, if your standard deduction is $12,000 and you only have $5,000 of itemized deductions, well, if you give $1,000 to charity, your itemized deductions would go up from $5,000 to $6,000, which is still less than the $12,000 standard deduction. And so one way to do that, to fix this, is to make a larger contribution to what's called a donor advised fund. So if you're someone who if you have the cash available and you want to make a $1,000 donation every single year, you could theoretically put $10,000 into what's called a donor advised fund, and you get to write off every dollar in the year that the contribution's made. That would theoretically get you above the standard deduction and allow you to capture the benefit of it. Now, what happens with this donor advised fund? You put the money in the account. It's an irrevocable contribution, but once the money's in the account, you get the deduction in the year that you put it in, and then from that point on, you can instruct the servicer of the donor advised fund, the brokerage firm handling it basically, how and when to send out the distribution to your charity of choice. So if you're someone that gives $1,000 to your local church or the Salvation Army every single year, and that's not giving you a tax benefit because you're below the standard deduction, well, if you can lump these things together, make a one-time $10,000 contribution to get over the threshold, you put the money in the account and then dole out $1,000 a year from that account, solves your problem. The second thing you might want to consider is if you're 72 years old or older, you might have a retirement account that requires you to take mandatory distributions every year. The IRS, by and large, likes to tax us on that money, and they force us to take a little bit out every single year once we hit age 72. Same goes for this situation. If you're somebody that has to take money out of an IRA, that distribution is going to be taxable income. And if you take that money and then you give a little bit out to charity, you might still find yourself below the standard deduction when you add up your itemized deductions. That charitable gift doesn't really help you. Well, this is where a qualified charitable donation comes into play. As you take the money out of your IRA for the year, before you do that, let's say you have a $25,000 required distribution, you could theoretically take $24,000 of it out in cash and then call your broker and instruct them to send $1,000 directly to your charity of choice, local church, Salvation Army, any 501c3 by and large. Because the check goes directly from your brokerage account to charity, it's not counted as an itemized deduction, but it does satisfy your RMD. So you get the benefit of it. It's not counted as income, yet you satisfied your mandatory distribution for the year. So if you're charitably inclined, those are two options you might want to consider as we approach the end of the year.